But I think the main reason that the recession hasn't started in earnest, meaning in a way that the unemployment rate is really up and it's obvious that we're in a recession. The reason for that is the unprecedented fiscal stimulus.
Peter Schiff debunks the myth that boom times are good for the economy, revealing the hidden dangers of government interference and manipulated interest rates. He challenges the notion that recessions are inevitable in capitalism, placing blame on government manipulation. Schiff predicts an imminent recession, cautioning against reliance on fiscal stimulus to mask economic vulnerabilities. He highlights the unsustainable decisions prompted by low interest rates and warns of severe consequences due to massive government deficits and mounting debt. Schiff's analysis calls for a reevaluation of economic strategies, advocating for a more sustainable, market-driven approach. With that, let's dive into his thesis. Also, make sure to hit the like button, subscribe, and drop your comments below.
So the bust, the recession, is actually the good part. It's where the mistakes are corrected. The bad part is the boom. Now, of course, the boom is the fun part, right? And so nobody wants the boom to end. But the sooner a boom ends, the sooner you can start fixing the mistakes, because they're not real. They're not legitimate. They're an illusion. Now, a lot of people think that these boom and bust cycles are somehow, just inevitable. They're just part of the free market. We just have to suck it up and bear it. It's like one of the costs of capitalism, that there's inherent booms and busts. And that's not true. It's government interference in capitalism, government manipulation, particularly with interest rates, that causes this so-called business cycle. If you take government out of the equation and have sound money and have free markets, you're not really going to see these booms and busts. So it's government that is responsible, not the free market. And so interest rates are low, and businesses start to do things based on these low interest rates, and then interest rates aren't low anymore. The Fed can't keep them down indefinitely. Eventually, they have to go up. And now, the people that you might have hired, you need to fire them. A lot of stuff has to be reversed because it's unsupported by the actual term structure of money and time preferences. The signals that a free market would have sent were short-circuited by the government. And the investors, or the people, don't know the difference. They just react to the low rates, just like the restaurateur reacted to the extra people showing up at his restaurant. Now, anyway, so the other thing, though, I wanted to talk about, so not only is it wrong for people to expect that we're not going to have a recession, we're going to have one hell of a recession. One of the reasons, though, that people are now convinced that we're going to skirt one is because we haven't had one, right? Oh, look at where the economy is. The Fed has already raised rates up to 5%, and we're not even in a recession. I mean, the economy is growing. We have low unemployment. I guess we're so resilient that the Fed just did a masterful job, and we're in great shape. People are underestimating this, because what I think has delayed the onset of the recession. Now, of course, we actually started the recession, and they denied it because, we had 2 quarters of negative growth, and everybody said that doesn't count, right? And then, we started to have the positive numbers. But I think the main reason that the recession hasn't started in earnest, meaning in a way that the unemployment rate is really up and it's obvious that we're in a recession. The reason for that is the unprecedented fiscal stimulus that has accompanied this tightening cycle. Yes, the Federal Reserve has raised interest rates and shrunken its balance sheet, right? So that is a tightening. So we've had restrictive monetary policy in that respect. But fiscal policy has been highly stimulative. In fact, it's been unprecedented in the amount of stimulus. If you look at the sheer size of the deficits and the money that has been spent, especially the money that was, spent during COVID and immediately after COVID. So I think we were able to buy ourselves some time before the recession by spending a bunch of borrowed money. So it's the deficits. In fact, I've seen analysis. If you just take the government deficits out, we'd be in a recession without that money, without the spending, because we're not really measuring economic growth when we look at GDP. We're just measuring spending, right? There's no differentiation between what the money is spent on. It doesn't matter if you're building a factory or just buying imports. It's still spending. The government spending money is the same as a private citizen investing money. It all counts toward the GDP. So we borrowed trillions of dollars and spent it, and that all went to the GDP. But what we ignored was the other side of the ledger. In order to get that GDP growth, we had to borrow an unprecedented amount of money. And the national debt continues to surge. We're now above 33.73 trillion, almost not quite at 34 trillion. We'll be there soon. We are adding debt 3 to 4 trillion pace per year, even though the official budget deficits now are only 2 trillion. We're probably adding debt at about twice that rate without the recession. Normally, when you have a period of economic growth, which everybody tells us we had, right? We had all this economic growth. Normally, that's when deficits come down. The economy is growing, right? Not only doesn't it need fiscal stimulus, but a growing economy on its own automatically reduces deficits. How? Well, growing economy produces more tax revenue, and fewer people need government assistance when the economy is good. So normally, during a good economy, the deficits are coming down. But this time, in this supposed good economy, the deficits are skyrocketing. And those deficits have been helping to keep the economy out of recession. But they can't do that indefinitely. And when the recession hits, it's going to be so much worse as a result of all that extra debt that we accumulated to postpone the onset of that recession.
Thanks for joining us today as we explored the insightful analysis of Peter Schiff on the economic cycle and the looming challenges ahead. To recap, Schiff emphasized the misconception that boom periods are the good times, shedding light on the true threats posed by government interference, particularly in manipulating interest rates. As we navigate the complexities of fiscal and monetary policies, Schiff warns of an impending recession and highlights the unprecedented fiscal stimulus that has temporarily delayed its onset. The massive government deficits and accumulating debt raise concerns about the severity of the recession when it eventually hits. If you found today's discussion valuable, don't forget to subscribe to our channel, hit that like button, and ring the notification bell to stay informed about future content. We appreciate your support and value your opinions, so share your thoughts in the comments section below.